Everyone for coming today. Here in the room, you've been rewarded with a copy of the great book Read, Write, Own, Building the Next Era of the Internet by Chris Dixon. And thanks to those of you joining us online. I think we're going to have a good, interesting conversation. We're skipping straight to the conversation, and we're going to have a good chunk of time available for questions. I'll challenge you online to put something good at the hashtag Read, Write, Own, and I'll try to pick that up and translate your questions or repeat your questions to Chris as we go along. But let's just get right underway with the question that I initially tweeted I would start with. I don't know if you recall this. What is read? What is write? And what is own? Just take us through what this title is about.
For sure. Is this on? Can you hear me? Sorry, I can't hear. Okay.
We're good? Yeah.
Yeah, great. So, well, thank you for having me, and I'm excited to be here and talk about the book and answer questions. So the Read, Write, Own refers to kind of my view of the history of the internet, and specifically in sort of the 90s era of the internet. By the way, the read, write part is not my terminology. This is was common terminology in the 2000s. People also called the sort of 2000 era Web 2. It was also called the read, write era. And the idea was sort of the 90s internet was about democratizing the consumption of information. So for the most part, websites would take information, put it online. You know, you'd have, it'd be really great to find out about, learn about some topic. But for the most part, it was a one-way medium. And then in the 2000s, this is when I started my career, and I was an entrepreneur, and I started two companies in the 2000s. The internet became about making it sort of a two-way medium, and so this was the rise of blogging and social networking, and basically the idea was, instead of simply democratizing the consumption of information, you could also democratize the publishing of information. And so sort of as an analogy to kind of a hard drive, like you can read it from a hard drive or write from a hard drive, people called it the read-write era. And so there was actually like a very popular blog called the Read-Write Web. People called it Web 2. And so that was sort of a common movement, sort of title, name for that movement. The own is sort of my addition to it, which is the idea that if I'm correct, I would like to see sort of a new wave of internet services that add sort of a third layer, a third feature to the internet, which is, if the first era democratized the consumption of information, the second democratized publishing, the third era is democratizing ownership. And so specifically, kind of the thesis of the book is that blockchains, the best way to think about blockchains is that they enable digital ownership. People are mostly familiar with something like Bitcoin. So Bitcoin is, of course, the first blockchain that was invented, in 2008 and launched in 2009. And the key feature of Bitcoin is that you own your Bitcoin, and you truly own it by having the private key, by having the secret code. You own it, and there's no one can take that away or change the terms or raise the rates or do whatever might happen at another digital service like PayPal or Facebook or something like this, right? And so the idea is that, and this is what the entrepreneurs we're working with. So I'm working in venture capital, and we invest in entrepreneurs. They're working on a new wave of digital services where ownership is a key component. And that has all sorts of consequences, and I go through this in the book. So just briefly on the book, the first section is the history of the internet, and I go through these different eras and kind of explain how the internet has sort of turned out the way it is today, which is highly consolidated. There's sort of five to 10 companies that control most of the internet, and I go through all that data and things in the book. And in the next part, I talk about blockchains and explain this concept of digital ownership in detail. So, and I worked very hard to make this sort of an accessible, relatable, I hope people find it that way, like just sort of an easy to digest kind of understanding of it. And then
as I was reading, I was saying to myself, this is like the book I would write, but I would probably require people to understand what a one-way hash is and what public key infrastructure is.
I tried to assume no knowledge. I mean, look, a lot of it was inspired by, I've been coming to DC, I've been going to other places, talking about this, and I often get asked, what book should I read? And I just think, look, I think a lot of the tech books, and particularly blockchain books, just kind of, they use a lot of technical jargon and are hard to understand, and so I really tried very, very hard and kept rewriting it so that it's very straightforward in their examples. But I go through and sort of explain, then ownership has these secondary consequences. So let me just give maybe an example, which is like there's a new wave of social networks that we're investors in. And the key feature of these, like one's called Farcaster that's sort of getting popular. The key feature is the user owns their name. Like I'm C. Dixon on Twitter. And you own your name and you own your audience, okay? And so what that means is and this sort of goes back to the early internet. This is how email works. If you have an email newsletter, you own that audience, you own those names. If you use a provider like Substack or MailChimp and you don't like how they're treating you and they raise the rates, you can switch. You can take that audience with you and move. If you contrast that to a service like Twitter or Facebook, if you don't like how they're acting, if you don't like what Facebook or Twitter is doing, you can't leave, right? I've spent 15 years building up an audience on Twitter, and if I don't like what Elon Musk does, or I don't like what Mark Zuckerberg does on Instagram or Facebook, I can't leave. The difference is in sort of this new model of blockchain-based services. There's genuine digital ownership in the sense that I own my audience, I own my name, I can leave. You can make video games where the user, the most common business model for video games today involves virtual goods. This is how Fortnite and League of Legends works. You buy virtual goods. But those virtual goods the user doesn't own, they can't take them from one game to another. In this new model, like the user owns these things. And so ownership has these downstream consequences, like changing the economics of networks, changing the controls of networks. So it allows for sort of the building block in which you can build a new wave of digital services that have very different governance and economic properties from the existing wave.
Yeah. Let's do a digression into ownership because I'm interested in that as an abstract concept, and let's do some more building blocks, and then get further into it. You're speaking of ownership, I think, not in a sense that we think of in the tangible world, where that coffee urn, if I own it, I can exclude everyone else from it. Nobody else can use it. You're talking about possession largely. I have a list of people who receive my communications, or my friend list, or my email list, or whatever it is. I have possession of that. I can use it as much as I want. No one can take that possession away from me. The platform can't take my use of it away, and that part of ownership. Obviously, I don't get to exclude others from someone else's email address. This is some subtleties of property rights that are interesting, and sort of.
The book Mine. Have you seen this? It's an economics crowd. It's like two economists writing about the 6 different aspects of property rights. So just to go to your point, it's interesting. But great book, except that was like the whole time it was driving me crazy because it's like they ignored the internet. But otherwise it was great. No, but you're right. It's not exclusionary in that sense. It's more in the sense of like control and exit. Yeah. You can exit and switch, and that switches the power in economics.
Yeah. And so I mean the term platform for a lot of the current social networks. Kind of applies well in a property metaphor because you are on their platform, you're on a piece of earth that they own, and you're a little bit more like a medieval serf than you want to be because they decide what benefits you have from residing there and what benefits you don't.
Kind of the early web, right, where you have a website. I mean, you still have this, but it's been marginalized. Where you have a website, and I think in the 90s web, you had your little plot of land. You had Google.com. And that because of that plot of land, that meant a couple of things. One is if you could have a direct relationship with your audience, if you're a creator or something else, but also it created incentive for entrepreneurs. Right? You knew Larry and Sergey and Jeff Bezos and these other people knew that if they built a website and became popular, they owned it, they controlled it. That is not true if you build an audience on one of these modern platforms. Right? I mean, like go on YouTube and search demonetization. Like it's a very common, or search the deplatforming, or really the deplatforming is sort of the most visible, but really a much more common issue is just algorithmic changes. You're at their whims. I met a guy last night, we had a book event, and he's got a big Instagram following, and I always ask them, how much money do you make on Instagram? The answer is always 0, because you can't make money on these services because they have 100% take rates. Take rates is the internet term of art for the percentage of money flowing through a digital service taken by the operator. I was just with my colleagues. He was in an Uber last night, and the driver asked him how much he paid, and he paid $75, and the driver got $16, right? And where'd the rest of the money go? It went, to taxes and things, but a lot of it goes to the service provider. The take rates on the internet. I have a section on the book on take rates. The take rates on the internet are extremely high, and that's due to the fact that these services have network effects, capture the users. You can't switch. you're stuck there, and they have complete economic control. And so,
and you're getting past the building blocks of the conversation I want to talk about, because I want to do more education, as you do in the book, on protocol networks versus corporate networks. And so you can just sort of, you know.
Yeah, I mean, so basically kind of like I have these three terms. So protocol networks, corporate networks, blockchain networks. Some people will call protocol networks protocols, like this is referring to like HTTP and SMTP for those who have that background. Corporate networks is my term for just like a network that's built like eBay, Facebook, Venmo, PayPal. They're ultimately roll up to a company. And blockchain networks are what I think are this new interesting thing, which is you build these networks on blockchains. Why the word network? Well, one, they are networks, literally in the sense of like nodes connecting to each other, but very importantly, they have network effects. Okay, so and network effects are the strongest form of defensibility that exists in economics, right? So like in the offline world, you had, you know, for those familiar with like Michael Porter's 5 Forces and all these kinds of business economics frameworks for defensibility of businesses, typically in the offline world, you had economies of scale, economies of scope. You know, you would have advantages for scaled manufacturing and distribution, and that let you earn some kind of, maybe you had patent protection, right? But network effects are just much, much stronger force. If you get, you know, if you're Facebook and you've got 5 billion people or whatever the current number is, you know, it's a very strong force. It's very hard for a new network to compete with that. If you're a dating site with 5 people, no one wants to use it. If you're a dating site with 5 million people, you're unstoppable, or 100 million people, you're unstoppable, right? So, so those are the kind of 3 things, and then kind of the first chapter, one of the early chapters is on protocol networks, the history of them, and then specifically the economic. This is really a book about the internet through the lens of economics and power. That's what it's about, and so and I provide a history. Actually, I have the most positive. I keep getting positive feedback on the history part. People seem to like that. I think one is just a lot of people don't know the history, but it's specifically, I don't think anyone else has written a history through this lens of like economics and power. Like why did the internet, like why was the internet of the 90s an open decentralized network where money and power flowed to the edges? And why is the internet today a centralized network where money and power? I mean, that's just empirical fact. Is it like it flows differently? How did that happen, right? Yeah. Like I spent a lot, so that's, you have to understand protocol networks and corporate networks. And then specifically with corporate networks, I argue that they all follow this one predictable pattern, which I call the attract-extract cycle, which I've seen over and over again in my career, which is when you start off, like I say, I create a new social network, okay? If I'm a startup, and I work with a whole bunch of startups to do this, when you start off, you're of course trying to get as many people to join you as possible, right? You're trying to get people to, you know, users to join your social network, media companies to join your social network. You want as much content, you're a startup. And then every technology follows an S-curve, right? It starts off, and if you're successful, it starts to ride it, and it grows. And as you're at the kind of the high growth point of the S-curve, everyone's happy. This is like Facebook 2010. Everything's growing, everyone's happy, okay? Like this is just generally how markets work. When things are the pie's growing, no one's really fighting. Then what happens, and this happened about 5 years ago, is all of these networks kind of hit the top of the S-curve. And so you just think about the logic of a Facebook or Google, like Wall Street expects you to grow 20, 30% a year every year, if you read the Wall Street reports, right? But at some point, your organic user growth is not growing 20% year over year, okay? That's why if you go on your mobile phone right now and you search Google or you search Amazon, you'll see more and more of the search results are sponsored links, right? That's because the only way these companies can still achieve this growth is they need to extract more money from the network. They need to have, and the way that most of them do that is they change the mix of organic and promoted content. More and more of it becomes ads. Or if you're a creator, you start off, TikTok a couple of years ago, creators, you know, you were a big creator, you got 100 million followers, and they just sort of let it rip. Right now, they're very carefully like gating, go ask them. I spend time in LA, talk to these people, you know, or other places where these creators live, and they're getting throttled, and they're basically the operators are figuring out, like, by the way, a lot of this happens with AI. It's not like someone's scheming behind the scenes, but you write an AI system and it's like, let's maximize profits, and it turns out the profit, and none of this is like an evil scheme. This is just profit maximization when you're scaled. When you're scaled network, and you can't grow organically at some point, your system, then you start optimizing it by showing more ads and doing this. I don't know if you've noticed, Amazon now, you have to scroll down like pretty far now to get beyond the sponsored links. A lot of Google searches now, it's literally all Google properties and ads on the first page, you know, above the fold. And this is just going to keep happening and get worse. By the way, the new thing they're doing, so then what it's like this cat and mouse game, and then so like entrepreneurs create like escape hatches, and so that's what like Patreon and Substack are escape hatches, right? Because they're built on the protocol networks, the early web. What Patreon's built on the web, and Substack's sort of built around email. And so why do like journalists prefer Substack? Because it's a 10% take rate, right? So you can't make money on Twitter and these other ones, but if you take your Twitter audience, link them over to Substack, get them to subscribe, you can make a lot of money because you have a lower take rate, okay? But now what's happening is all the social networks are clamping down. If you guys have followed it, the link-pocalypse, they're calling it on Twitter. If you have a link to Substack, that tweet gets demoted, okay? And so so there's this cat and mouse. So they're basically in this extract mode, the big networks, and we're going to see this more. It's just inevitable. It has to happen. It's just the economic logic of these systems. The next 5 years, you're going to see more and more clamping down, more and more attempts to have these like 5 to 10 properties be the only thing you visit on. Like the big thing now is time on site, time spent. You're going to see these people talk about it more. And then you toss AI into that, right? And we're very, they're going to have AI as a technology that inherently rewards companies with large pools of capital and data. So it's sort of inherently centralizing if you don't counterbalance it. And so then you're going to have, I think we're very close to, if not there, having an internet that essentially is going to be 5 companies that control everything. The
book is doing a lot of the work, and this presentation does a lot of the work to make me recognize what a wasteland it is nowadays. I'm thinking about my Facebook experience and my Amazon experience. You're just getting this kind of corporate presentation, automated stuff rather than what was real in the early days. So. Let's spend a little bit of time definitionally on the third type of network, which is the blockchain network. Can you do a quick what is a blockchain for people? Everyone's got a different version. I'd like to hear yours.
Yeah, so I call blockchains computers as opposed to ledgers. People sometimes will say they're ledgers. A ledger implies you store something. A computer is more than that. A computer is you store something and you also do something to the thing you store. You can write code for it. So if you take a blockchain like Ethereum, you can write arbitrary code for it. You can write anything. You can write a game. You can write a social network. You can write whatever you want. It's code. It's software. Software is an incredibly expressive medium. So something like Ethereum I call it a computer in the sense. I go through it in the book. I mean, people push back on that, but it's just not a real debate. If you go read all the original Turing papers and things, which I cite in the book, like that is what a computer is. It's something that stores information and writes code that operates on the information. Now, it's a virtual computer. It's not a device. There's not an Ethereum device. It's a virtual computer. It's a computer in the sky that kind of works, that is built on top of a network of other computers, right? There's things called validators. There's like, tens of thousands of Ethereum validators. And so you write code for it. It acts like a single computer, even though it's run. This is, of course, what Bitcoin too, right? Bitcoin is a computer in the sense of like it's a computer that has a single function, which is to keep track of the Bitcoins and who has them and how it's spent. Ethereum generalizes that concept.
It's pretty wild. It's pretty wild to have a global ledger system. Yeah. Bitcoin is optimized for transfer of value, but you can have global ledger systems for all kinds of things, naming on the internet, property records, and so on and so forth. To take it to the next step, I think is exciting to realize, oh yes, you can also have a ledger that stores code, forgive me for botching it in certain senses, that stores code and then can also operate code so that it does operate. And I think that's a nice fun mind bender. And that's operate code and make a global computing system.
It's important that why I use the word computer. I have a section on this. There's because computers tend to follow a certain process. I call it the platform app feedback loop. I think folks have probably heard of Moore's law. Moore's law is this idea that you ask this question like why? Okay, if you took a video of this room 30 years ago, or whatever, any place we go around the city, a lot of stuff would look the same as it does today. The thing that's really different is we now have a supercomputer, internet-connected supercomputer in our pocket, right? It's kind of remarkable. Like I use the example of I think I use Friends. I think I use the show Friends in the book. You watch the show Friends. I might use it in some podcasts. It was 1996 to 2003, and I was at the dentist's office watching Friends. I don't really watch it, but it's funny because it looks just like the modern world, except there's no smartphones. And just generally, you look back, and so the question just is why is that the one thing in the world that has changed so dramatically in 30 years? Why haven't washing machines gotten so much better? Why haven't, And the answer is that there's some. I mean, the answer is twofold. There's Moore's law, which is the fact that you can pack more semiconductors on a chip. There's a physics, right? I mean, that matters. You can't there's nothing like, you can't do that with bridges. You can't just make 10,000x better bridges. It just doesn't how physics works. So that matters. But I think more importantly, that often gets overlooked is an economic phenomenon, which is the fact that you have this interaction between applications that are created and the infrastructure. And let me explain that. So this phone here, my iPhone, is vastly better than the original iPhone that came out in 2007. But the other thing is that the apps are much better, right? So like you have Uber and Instagram, et cetera. And what happened is Apple released the first iPhone. I still have my original iPhone. It was a little dinky thing and everything else. And then somebody started creating, people made some games, and then people made this, and then someone made Instagram, right? And then you have Instagram, and then that then makes more people buy the phone, and more people buy the phone, which gives Apple more money to invest in better chips and cameras, and those get better. And then as they get better cameras, the cameras could then do video, and then someone invented TikTok. So it's this back and forth economic loop that ends up, you take two kind of linear processes and combine them, and you get this exponential growth, okay? And so computers follow this. Computers have this special property that you basically unlock humanity to say anyone in the world can create an application. And it turns out when you do that, I liken software in a lot of ways to like writing in English or something. Like once you sort of say anyone can come up with something, and people come up with all this crazy creative stuff. I was an entrepreneur and investor when the iPhone came out. It was a really fun time because you'd have all these meetings. Like, what could you do with a handheld supercomputer in your pocket that has GPS, and it was funny because we had all these theories as to what would happen, and then you see it play out, and this sort of the Darwinian struggle of startups, and then out of that 20 interesting things or 50 interesting things emerge. And so when I saw sort of Ethereum, it was like a light bulb went up. This is a computer, and it should follow a similar kind of process where you have it get better and better, and that's been happening. Like the computers have been getting better, the Ethereum system, the performance, the price, the security, like all of those things. People are building applications for it. And so anyways, to go back to blockchains, one might ask, why go through all of this trouble? A very reasonable question of like making a computer that runs on this network of computers, right? And the answer, the way I like to put it, is it's with a traditional computer, the hardware is in charge of the software. And with a blockchain, the software is in charge of the hardware. And let me explain that. If I put up a server and I say I'm going to have Chris Coin, my competitor to Bitcoin is Chris Coin, and there are only ever going to be 21 million coins, and I wrote code to say there's only 21 million coins, if I'm the owner of the computer, I can just change that number, okay? If Google said they have Google Coin and they're going to only have, they could just, anytime you're using a computer on the web, you're trusting some other party, okay? As they like to say, as some people say, some people say the cloud is just a word for somebody else's computer, okay? Like that's what when you're using the cloud, you're using someone else's computer. And as a result, they have all the power over the economics and over the control and the governance and everything else. The point of a blockchain is that because of the kind of mechanism, what's called the consensus mechanism, kind of the way these computers interact, it has the property that if you write code for it, that code is guaranteed to continue running as designed. That code could, for example, as Bitcoin does, guarantee there'll only ever be 21 million Bitcoins, but it could also do something else. So what Ethereum, you can write, I can create a social network, and the social network promises that it will always have the following privacy policy towards your data. It will always have only charge you 1% of the take rate or something. You can have it make all sorts. You can say you promise software developers that it'll have an open API and anyone can access it, and we won't change it. That, for those who don't know, the tech industry, there was this huge wave of people building on Facebook and Twitter in the late 2000s. A lot of my friends, I was an investor in a lot of these companies, and in about 2011-12, Facebook and Twitter and all these companies shut down their APIs, and it just destroyed a whole era of startups. So that's why, to people like me, that's a big deal. If you can build a social network or game or whatever where you have commitments to the API. So I call blockchains computers that can make commitments. They can make commitments to developers, they can make commitments to creators, they can make commitments to users. Bitcoin makes the commitment to that it'll be 21 million Bitcoins. You can't double spend a Bitcoin. Ethereum lets you make arbitrary commitments, whatever the developer wants to create. And so it's really, to me, what's exciting intellectually, like I think of Ethereum as one of the great, I'm using Ethereum as an example, but programmable blockchains generally, I think of it as one of the 5 to 10 great ideas in the last 80 years in computing, because it unlocks a new class of applications. And that, to me, what's personally intellectually exciting about that is then you can go and sort of collaborate with entrepreneurs and think about like what are all the new things you can create in the world when you have that. And I think it arrived at a perfect time because it arrived right when these internet services were not very trustworthy. And now you could create a new wave that, that can make commitments.
We're at risk of burying people in tech talk. And we're not even doing cryptography.
Sorry, I'm trying to
we're not even doing we're not even doing the cryptography stuff.
Okay.
But let's give them a little tokenomics.
Okay.
If you can think of an example better, by all means do, but I think of services like Filecoin, where a coin, like Bitcoin, this thing of value can be passed around and used to buy and sell services, to create incentives. Almost like a game world, but this is real world stuff doing highly useful, not that gaming isn't useful, it's entertainment, solid entertainment, but useful business things. And otherwise, can you talk to us a little bit about how tokens work to build incentive structures and communities that way?
Yeah, I mean, you mentioned video games, and I talk about that in the book a little bit, because video games, for those who don't know, there have been sort of virtual economies in video games for 20 years. It's, EVE Online is a very famous video game. It's a space video game, millions of players, and there's a whole kind of economy. They hired an economist to manage that economy. And so a lot of sort of stuff that happens in the blockchain world was inspired, I think, by the video game world in this way. Maybe I'll start with Ethereum just because it's more famous or more understandable. Ethereum has its own little microeconomy. And so the way Ethereum works is it's this computer in the sky that nobody owns, anyone can access. You can write code for Ethereum. The way it works is it charges the developer to run that code, because it can only run a certain amount of code. So it has a market that it's called gas, and it fluctuates by supply and demand. And so if you make a game and you want to run that game, you're going to be paying some gas, okay? And the last 12 months, Ethereum generated roughly $2 billion in revenue through that method. People paid $2 billion to access it over the last 12 months. It then takes because it's not a person, it's a system. It's an automated system that does not depend on any human beings. I mean, at the Ethereum level, there are these validators underneath. But that system then has a little microeconomy where it then, for example, pays what are called validators, who are the people that actually run the code and pay the electricity to run that code, right?
The equivalent of miners.
That validator is sort of a generalized term for miners.
Yeah.
It's just it has to do with for those who know, miners typically refers to Bitcoin proof of work systems, and then there's sort of a more generalized term that includes proof of stake for Ethereum. So I don't know how as people that are into crypto, maybe I'll ask, I don't know how. Okay, so I don't know if I'm speaking at a really advanced level. I'm used to speaking to more tech, to Silicon Valley audiences.
I'm trying to slow us down.
Okay, sorry. But think of it as like a little microeconomy. And so people pay into it to access the economy, and then it spends money on different things. And actually, if Ethereum, the way it works, it's a little Federal Reserve type thing. If it has extra money, or like a company or whatever analogy you want to use, like in this last 12 months, I believe it's had excess money, and it's used that to basically reduce its supply. So it's been deflationary. There's a bunch of websites you can go track the actual stats. And so that's how Ethereum works. There's other examples, like we funded one recently. I think it's pretty interesting. It's a bunch of Stanford PhDs who are basically working on the problem with AI systems. One of the interesting problems is that a lot of these AI systems were, so they were trained on other people's data, and they didn't pay them for that data. And I think that's going to be a growing question of okay, so you created this system that can, generate images or music or text, and you train that system on, I think this would be a political issue. You trained it on musicians' data, and now you're creating music that's replacing musicians' jobs. The New York Times just, filed a lawsuit against OpenAI over this. They, said you used our text in your training data. This will probably play out in courts over many years. I think a better answer than sort of fighting over it is figuring out an economic model for this. So like this team that we just funded, what they do is they have a system that the AI system can sort of basically attribute where did it get this data. It got this result came from which data. And then if you generate $1, you pay some portion of that back to the people that provided the data, as an example. And that uses that's so you said tokenomics. That's you do that through using tokens.
Can you give me the quick and dirty on how blockchain enables
so
that to happen?
blockchain is that economic coordination layer,
Okay.
right? So it's the layer that says, okay, you this much of the kind of the result was due to this data, and so it then figures out that attribution and pays out that money. So it's basically, in some ways, solving a collective action problem as much as a technology problem. And a lot of what blockchains solve are kind of more almost political collective action problems. It's like, how do you get a bunch of people together who don't clearly trust each other? Like, how do you coordinate?
Don't even know each other.
Yeah, a million artists online to sort of come together and collectively bargain against these 5 companies. I mean, so yeah, in the chapter in the book, I go through kind of the history of, so maybe those who don't know, like the way that search engines evolved. So what happened is in the 90s, search engines like Google basically relied on fair use to go and crawl and scrape websites and then use snippets of it. And then, and at first, the websites just thought it wasn't that big of a deal. Great, I get more traffic. But then over time, realized, wait a second, they've now collected everybody, and we're only getting breadcrumbs, and that led to all these lawsuits. Fox sued Google, and a bunch of other people did. And then basically, by the time they realized that they'd kind of given up the economics of the internet to these intermediaries, it was too late. But it was really like what they should have done, I think, at some point, is gotten together all of these kind of content sites and joined together in some kind of collective way and said, Google, you can only use our data if you pay us a certain amount. But it was a collective action problem. How do you get them all to coordinate? And so you can use one use of blockchains, in this case with AI systems. I'm promoting this idea that people whose data is getting used by AI systems should get together and come up with a kind of collective bargaining agreement, and the digital form of a collective bargaining agreement is a blockchain. Like, that's how you implement that.
Would you register your content on a blockchain and say, this is the content that I produced?
There's different ways to do it, but essentially.
The tracking of, say, the identifier of a particular transaction or block would be used to determine the result, what it contributed to the result.
There's different ways to do it. Another way to do it, so there's like I don't know how much people follow the AI stuff, but there's like, most AI systems have a 2-stage process where you first do kind of the main training, and then you do what's called reinforcement learning on a smaller data set, and that they're fine tuning. And basically the problem that a lot of these AI systems have today is they've run out of data. So like ChatGPT, they were trained on all of the internet data, all of the Gutenberg library, all of the history of, like, they've literally used everything. And so the question is, like, how do they get smarter? Right? Like, there's a big question right now around these systems. It's like, you can get smarter by putting more compute on it, but it looks like most people, I think the bottleneck right now is data. And so another way to think of it is you can use a blockchain to incentivize new data collection. And so you say, okay, I need a whole bunch of people to give me images of this genre or something, and then you pay them for doing that, as an example. I don't want to get too hung up on AI. AI is just one area that you can use blockchains to.
Can we fix social networking a little bit? Maybe take me through how you would use a blockchain-based, you would create a blockchain-based social network, or an example of one that you think has a lot of potential.
That I use a lot. It's called Farcaster. You can download it. There's a client for it. It's a protocol, so it has different clients, and it works just like email, in that it's a social network, so it's a protocol. But there's different, just like with email or with the web, right? With the web, you can download Safari, you can download Chrome. Like, you don't download the web. You use the web, right? And so this is how blockchain-based social networks work. There's like Warpcast is the most popular client for Farcaster. You download Warpcast. It feels just like Twitter or something. Just the user experience is very similar. And there's a couple 100,000 users on it or something right now. It's growing. Hopefully it'll grow more. It's early. And the big difference is you own your name, you own your audience, you can switch software providers, you can bring your own algorithm. If you can say, I want to use an algorithm that ranks content this way, you can choose, right? You can build your own, if you build an audience, you can decide you want to make it free, you can charge them a subscription fee, you can do whatever you want, it's yours. Yeah. For those who used RSS, it's like, I have a whole section on RSS in the book. It's sort of a next generation RSS. It's like it.
I enjoyed the RSS section of the book, because in the early 2000s I was creating some content, and you got to get out on an RSS feed, and that mattered for a while.
So
and then it stopped mattering.
I was a blogger in the RSS feed too. I mean, you probably you maybe know this. This was, for those who weren't around in the 2000s, like RSS was like a serious competitor to Facebook. I was a blogger who talked about it and wanted RSS to win, and we lost. And so,
you know, every time I talk, I seem to sound older and older, and I'm thinking a lot of you weren't around in the 2000s when we were trying to publish on RSS. I'm worried that the word own may conceal more than it reveals. So what's under the hood of own? Again, is it I've blockchain under the hood, and I've registered Jim Harper at Farcast, or Jim Harper, you know, some name. That's within my control, thanks to blockchain, because I have whether in the form of a true private key or some element of the app, I've got control over the private key that controls that name, and my relationships are data that I have control over because it's also on a blockchain. I'm sort of saying, but also asking. Right. Is that what's under the hood?
The name and the social graph are you control. Okay. You control your, like, think of it as controlling your audience. And so you can switch. So you can switch clients, you can switch software, you can switch algorithms without losing the thing that you value, which is your audience. Right. If you ask people on TikTok who are unhappy with the changes to the algorithm, or Instagram or whatever, and you say, why don't you switch? It's because I'll lose my following. So by putting the following on a blockchain and putting the name on the blockchain, you give them the ability to switch. And then you shift the economic and governance power from the application providers to the users, which, I mean, like, these are big. This is there's a big deal. Like, social networks generated 150 billion in revenue last year. Like, I think there's a very credible argument, and I make the argument, that if you architected social networks the way I'm describing, that $150 billion, instead of going to those companies, the vast majority of that would go to the users of those networks. So we're literally talking about a, you know, like, this may sound like I'm talking about some weird technical topic, but it's like 130 billion, probably. I mean, I'd say 130 because I think there would still be some take rate. Sure. There's always some kind of fee that the service is charged, but it shouldn't be a monopolistic 100% take rate. Yeah. So these are like very big economic issues that that somehow I feel like in this kind of psyop we've all been kind of convinced to think is normal. Like, that it's normal that you, on the internet, somehow people have been convinced that it's normal that you create content, you do all this work, and you don't get paid. I don't understand why this is not how the 90s internet worked. It's not how the 2000s internet worked. It's how the last 10 years of the internet worked. And somehow people have been convinced that this is the normal way it works, and it's not. And those companies in the middle are not doing that much. They're doing some things. They build some software and everything else. They should get paid. I'm not anti-capitalist, but I don't think they should get paid 100%. I think it's broken a lot of things on the internet, and I think it's just leading to a really bad outcome. Look, and I work in venture capital, and, like, we want to see a vibrant internet with startups. Like, we used to have a practice of, like, investing in consumer internet startups, and that practice, like, go look at the top startups, the apps on your phone. I go through this in detail in the book. None of them were created in the last 10 years. It's basically that has stopped. The diversity, the kind of Darwinian struggle I described before has stopped. These 5 companies have too much power now. And that's just, look, selfishly, that's bad for startups and venture capital. It's bad for my friends that work in my whole, you know, all of the people I know and work with. Like, that is over. And so now they're all doing enterprise software or something else because it just ended because those 5 companies are so powerful. I might reveal too much about myself, but I like to do net present value calculations on my own activities. Should I go fight with the cable company about this bill, or should I go work for an hour in the yard, which is going to end up having more value? If it's a recurring bill and you can knock it down by $100 a year, that's worth $2,000 at a 5% discount rate. Well, getting $100 billion out to creators per year, rather than with these large companies, that's a $2 trillion, or if my math is right, a $20 trillion value, might be worth doing. Yeah, I mean, you can look at the market caps of the companies as an NPV kind of net present value calculation. You can also, in the book, I put it in terms of jobs. That's 2 million jobs at the average salary. Like, and look, and then we have this AI thing coming, which, again, I'm sort of pro AI, I'm pro tech, but we do have to think about the fact that, like, it's going to take away a lot of jobs, and the way that historically the way that tech works is you need to create jobs while you take them away. Like, we need to create new internet, like, cash flows, like, if we're going to make the internet successful, and have it be a vibrant, medium that encourages human creativity and flourishing. And I just think that, I don't know, like I'm just kind of surprised, honestly, I'm one of the few people talking about this topic, which is like, what is the business model for people on the internet? Like, and what is it in the world of AI? And like, why do we just accept that that this has to be, all the money has to go to these 5 companies?
I like it. I like it. I like a pro-tech stance. I'm pro-tech as well. But I agree with you. Sort of a little bit of a let the scales fall from your eyes. That this is not that way it was supposed to be.
Well, then what? Maybe it's because I fell in love with the '90s, early 2000s internet, and I just still think that's the way it should work. And one day, sort of felt like woke up and was like, it's not.
Yeah.
And I think maybe people that are younger just sort of assume this is how it has to be. That it's sort of like it's like a monopolistic industry or something. I don't like. I think the cynical counterargument to my argument is like, and I've heard this many times. Is sort of, or I don't want to, but like just whatever. The counterargument is that this is what happens to all industries. They all consolidate. And maybe that's true. Maybe it's over. I think that the internet is different in that it's a much more kind of plastic, malleable medium than a lot of other things. It's not the economic structure I'm describing is just it's just built-in software, and with the right incentives and new designs, I think can switch very quickly.
Let me ask for some audience reaction on this. Are we 2 old men shaking our fist at the sky because the cloud is blotting out our sun? Or do you see some of the almost hippie early internet stuff that Chris is trying to get across and that I'm vibing to? Everybody who sees the early internet, let's see hands. No, what, a couple of people, and we're just old people lamenting our corporate future. Well, continue pressing on with what I think is an important vision. I do want to challenge you in a way on a couple of things. We haven't spent a lot of time on Bitcoin because Bitcoin's fascinating and it was groundbreaking, but it might be a little bit in the rearview mirror. I look forward to your reactions. There's this phrase in the Bitcoin world, Bitcoin fixes this. And we're doing a little bit of that right now, saying blockchain fixes this. And I think what the challenge is, how do we get there from here? Mm-hmm. I've blanked now on the social network that you're Farcaster has a few 100,000. There are two elements that I'm aware of that are big impediments to a new era, and one is just user interface. The corporate networks work well because there's someone there making it really easy for you. And I went on Nostr. I tried to sign on to Nostr the other day, which is Jack Dorsey's successor to Twitter, perhaps. Yeah. And I had no idea what was going on there.
Yeah. That's not. I don't know. That's not what I'm involved
with. But in a protocol, how are you going to end up with a user interface? Maybe Farcaster and the analogs to web browsers in Farcaster do enough to make it work, or what? So what? How do you get over the user interface hump? Where
I think that's come a long way. I mean, it's a couple of factors. There's sort of just the pure kind of software experience, which I think has come a long way. I think if you try like Warpcast, this Farcaster client, or one of them, you'll see that. A big thing was the kind of cost. Blockchains were very expensive, and that also has come a long way. So I think that is sort of like this thing I was talking about before, where you have these processes. Like I feel like that's just going well and getting better. I mean, honestly, the reason I'm in DC, I think the biggest challenge the space has is the policy side, which is just that there's all of these kind of questions around like the legal status of tokens and just kind of controversy, and then the kind of catastrophic stuff around FTX, which just all of the sort of scandals and things that happened 2 years ago. Which, by the way, we were not investors in FTX or any of those scandals, but it didn't, it just hurt the whole kind of image of the space so dramatically. Yeah, I think so. Well, I thought it was, anyways. But I mean, we avoided it, and I'm glad we did. But it's sort of the image of the space, the regulatory response as a result. To me, that's. But I feel like without those issues, this is sort of inevitable. There's, I don't know, tens of thousands of really smart people, developers working on this stuff. Like there's a lot of momentum if you kind of get into this world, and they're very smart, and it has the feeling to me of a lot of internet movements that are powerful. So that's my main thing.
correct me, I assume you're referring mostly to the SEC right now.
Yeah,
if you create a token system.
There's that. There's you know, just things around like illicit finance. So there's different dimensions to it.
Okay.
Yeah.
How would you, if you were to put a number on it, rating the height of impediments? How much is SEC uncertainty impeding people from coming in and creating new token systems? How much is financial surveillance impeding? How much?
Well, so the problem is, so like startups are created by, generally the most successful startups are created by people that have a lot of career options, okay? Like these are people that come from, like if you look at our portfolio, these are people that come from whatever, you know, top tech universities, you know, they built famous open source projects, like they're really, you know, highly talented people, and they have a lot of choices. And the biggest issue is not the actual, to me, is the fact that that the uncertainty deters those people. Okay, so it's the quality of the entrepreneurs that enter the space goes down as a result. So when you have, and I didn't understand this until I worked in this area, but now I've seen it firsthand, which is when you have this kind of overhang of these issues, it ends up being an adverse selection for talent. And so you have the talented people don't want to do it, and they want to go somewhere else and just, hey, I'll just work on AI. And on the flip side, if you're a computer hacker or a scammer, like, and your other career option is stealing money, like, why not create a token and maybe get fined and make more money? And so we've got this dynamic now where it's because of that attracting the wrong kind of people, and it becomes this kind of self-fulfilling prophecy. The cynicism begets reality if you don't attract the right people. So I mean, the regulatory stuff matters, and but the main thing, the point we make is having kind of black and white rules is what entrepreneurs want. They want to know. They don't want, you can't tell a top-end entrepreneur that there's a 10, yes, you think you're going to be fine, but there's a 10% chance that some agency decides to take some action, and like there's going to be like, well, I'll do something else where there's 0% chance. And so that's honestly the biggest challenge, right?
Have you resisted calling out specific agencies and regulatory systems because you're trying to get along with them and convince them to change your mind? It's okay if you are. It's okay to have meetings with people and not have a record.
I mean, as you said, like, look, the SEC is suing Coinbase. Like there's a whole bunch, like a lot of our companies literally, because they have the word blockchain on the website, cannot get a bank account. They don't even have a token or crypto. They can't get a bank account. So I mean, I don't, like those are probably the two. Like we have, I think, over 10 companies that just literally can't get. We literally have a full-time person whose job it is. This is like you graduate from MIT, you sign a term sheet with us. We're about to wire you the money. You don't have a token or anything, and we can't wire you the money because you can't get a bank account. Like that's actually the issues that we deal with. So So I don't know, but is that? I guess that's Treasury or no. I'm not. I mean,
well, this effect on the quality of people that you get in industry is another one of those sort of mind-bending dynamics that it's akin to. So regulatory uncertainty, it's much derided. This is like another reason. Is that you get lower quality people. There's going to be no direct lines between regulatory uncertainty and an FTX or any other particular explosion. But if you have regulatory certainty, higher quality people seeing better opportunity come into the space, and you get better quality, better quality product and better quality compliance. It becomes kind of self-fulfilling, or sort of like clarity begets quality, quality begets more quality. People see good products built. The biggest thing look, AI had been around for 80 years. I started an AI company in 2008. I sold it to eBay in 2011. Like, AI was like, people would roll their eyes. It had been around so long and it promised so much, and then boom, ChatGPT, right? And it just changes overnight. Like, this is how new technology sectors break through, is they have a breakthrough product, right? And there's a product that just wakes everybody up and they see it, and you don't need to go write books and talk about it anymore. I'm very much looking forward to that point where I don't need to explain all this stuff. And so ultimately this technology, I believe, will break through. It will break through a product, the way that AI finally broke through. Like when I did AI, like you wouldn't call it AI because it was embarrassing because it had overpromised for something. You call it machine learning. Now people call it AI because it's incredible. So ultimately that's how I think of it. The North Star is getting to the kind of ChatGPT of blockchain, getting to products that break through.
And how do we get to that point? And like we can, we can provide funding and we can provide guidance, but really what we need is the great entrepreneurs to enter this space. And so much of what we do is thinking about that. It's like, how do we get those great people to enter?
Let me just ask you about one vignette that I have in my mind. There was a company several years ago, I think it closed in 21, or I say company, project, whatever it was, Bazaar, which was much in the mold of what you're talking about. It was going to take eBay's take rate away from it by being an open blockchain-based marketplace. I know some of the folks who worked on it. I didn't talk to them about this question, but that seems to be a nice, clear example of all the technical pieces were there. Maybe I'm wrong about that. Why doesn't it happen? Why don't we have a replacement for eBay at this point in Bazaar or some other platform or protocol-based marketplace?
Yeah, I mean, because so my argument is that it's not that. So I mean, so there's payments, but payments actually, I mean, I think there's too much focus on payments, and probably from an economic point of view. So payments, the typical credit card charges 2.5%, but the consumer gets some of that back through rewards and things. So it's probably more like a 1% fee. So with payments alone, you can do that. I mean, look, eBay charges, they actually have a 10% take rate or so. So it's actually not nearly as onerous as most take rates on the internet. Why is it 10%? Is it because eBay is nicer than Facebook? Facebook's 100% take rate, eBay's 10%. Why is it because they're nicer? No, it's because the switching costs are lower. If you're selling shoes on eBay, you can also sell those shoes on StockX. Why can you do that? Because you own those shoes and you can switch. Okay, so it's all about the ability to own things and switch. Like, to me, that Bazaar, in some ways, we were actually investors. I was a small investor in Bazaar, so I know them. But in some ways, they were solving the sort of payment problem, let's call it. But I've come to believe that the real problem is this kind of balance of power between the user and the network operator, because that's really what determines the economics and governance properties. That's the core argument in my book. So.
Let me open.
They're also early. That was 6-7 years ago. You didn't have modern blockchains. You had high fees. So a lot of these things are timing. Mobile phones were. I mean, there's so much revisionism on the tech history. Like, mobile phones just came out of the blue. No, I mean, General Magic was 15 years before the iPhone. They were trying to create an iPhone. Like, I had smartphones 10 years before the iPhone. Like, this stuff takes. There's all of these things are there's a whole build-up period. Before they break through.
An illustration of that is. A fun one for me is visiting a company in San Francisco that had live telemetry from Formula One cars and video from Formula One cars. Awesome, amazing, amazing stuff. But broadband wasn't there yet, so they couldn't get it to anybody. So they had this wonderful product and died because the technical infrastructure wasn't there.
It was interesting. I remember the online video. I actually use YouTube as a case study in my book. YouTube. It was sort of this wave of entrepreneurs in 2005 who finally kind of realized that you had enough broadband hit 40% penetration, but people have been trying. There was real video and all this stuff 15 years before. To your point, a lot of these things, it's as I was saying before, it's this kind of interplay between applications and infrastructure, and the timing matters a lot.
Let's spend a little bit of time on governance, which is I think another sort of impediment type issue, and then I will go to questions. So have some questions in mind, and I'll be looking for questions at #ReadWriteOwn. I'm an early Bitcoin person, and I think we were in the green room. I characterized myself as affiliated with the losing side in the block size debate, which was a technical argument about how large Bitcoin blocks should be, which means how much throughput they should have, how many transactions per second. And nowadays, I often hear of people saying, "Oh, Bitcoin doesn't really work because it's got this low transaction throughput of about 7 transactions per second, which is really low for a global value transfer system." It's not cast in stone that Bitcoin was going to be that way. Arguably, it was a spam control that Satoshi wrote into the code originally. I'll try to make the other argument. The other argument is that Bitcoin is very, very secure because it has smaller blocks and they propagate well, so that the network doesn't centralize the way it may have otherwise. So I want to be fair. I want to be fair to that debate. But a lot of people saw that as a governance failure or as a problem. Certainly the losing side, right? The winning side would say, no, everything's working perfectly. But there's supposed to be this trio political actors, if you will. We're in D.C. I've been working in policy for years, so I think of most everything in political terms. A protocol change is a constitutional debate, and the balance of power in Bitcoin was going to be among three parties: the coders, the miners, and the users. Posit that each of them has a good understanding of how the code affects their interests, and you might actually have a triumvirate of actors who collectively come together on governance that works. But what seems to have happened is that the coders, the miners had no idea. They were just making money hand over fist at the time. The users have no idea. They're just trying to make as much money on the rise in price they anticipate in Bitcoin. And the coders had all the power, so kept the block size change, or made a technical change that isn't important here. That looks like a governance failure to a lot of folks.
Yeah.
And so are we talking about, really, you use the word a number of times in the book, democratic networks?
Yeah.
Or are these new oligarchic networks that are going to be meet the new boss, same as the old boss kind of thing?
Okay, it's a great question. So, I have a chapter on network governance, and so this is the basic idea. Is it kind of maps to the offline world, which is you have basically internet services that are autocratic and internet services that are democratic. And so early, the web and the internet are, in some sense, democratic in the sense of like who controls the World Wide Web. There are these various nonprofit consortiums and things that make recommendations, but they don't actually control it. Who actually control, like who decides if you want to upgrade the World Wide Web? Like it's really the software provider. So it's the popular browsers like Chrome, it's the web servers, right? So it's this decentralized kind of network of all of these people who support the software. They decide whether they want to support this change. If I try to change, I would argue Gmail is so powerful now that they arguably kind of can unilaterally control email. And in fact, there's a lot of people that argue that they've started to block small servers, and there's a whole separate debate about that. Because basically, sort of think of it as the more users you have on the network, the more votes you have in some sense. So they have so many votes that they can kind of hold it up. Now, of course, Facebook, et cetera, these are just monarchies or whatever, autocratic. Their CEO can unilaterally do whatever they want. The interesting thing with blockchains is that with Bitcoin, that's more like the web. It's what we call off-chain governance. It's just like it's just a network where like the software providers can just decide what to upgrade to and everything else. There's a new method that blockchains now use called on-chain governance, which is you have tokens, which are governance rights, and so people can get these tokens, and that gives them a vote in the system. And so you can have a system where people actually use their token, sign a cryptographic code, and vote, and that vote affects the code upgrade. Literally, there are systems like this today. You can have systems where there's sort of bicameral systems. There's a system called Optimism that does this, where there's a token voters to sort of the House, and then you have the sort of Senate or something, which is a set of foundations. Basically, what I argue in the book is the real innovation of blockchains is now you have the ability to write into code the governance system of an internet service. And this is the first time you could do that, because before you had this kind of rough democracy of protocol networks or this autocratic system of centralized services. Now you can write arbitrary governance code, and you can say, I want this system to work. I'm going to make a new Facebook, and whoever has the most followers can decide on upgrades to this. You can just make it up, whatever you want. You can invent something new. And so we have there's a professor at Stanford named Andy Hall who teaches in the political science department who works with us as an example, and he's written a number of papers and things. He and his classes are studying this. They think it's really interesting because it's now you can run these kind of experiments of like these communities. What if you have this kind of governance or this kind of governance, right? But my kind of broad argument would be, we're 30-ish years into the modern internet. Presumably, this is going to be a really important invention for a very long time. The services that run on the internet are going to determine the flow of money, information, politics, business, government. How do we control those services is an important question. And blockchains now let you dramatically widen the range of governance systems for those services. Like, I think that's a kind of a big. Now, I don't claim we have the answers. Like, I don't think we have the answers in the real world either, right? Like, I actually rewrote that chapter because originally I was I was trying to make stronger claims of like, hey, these are better ways to govern things. And I was like, that's just not accurate. The real breakthrough is we can now encode in software the governance of internet systems, and people are doing interesting experiments but I can't claim that we figured out any more than that we figured out, like real world governance. But I would say, especially maybe to this crowd, I assume has more of an interest in this topic, that like, I think it's just like a really interesting area to explore intellectually, is that you now can, you can now design in, any governance system you can think of for internet services can now be built and designed. And that could be, a social network, a game, a financial system, an AI system, whatever it might be. And, so you can have an AI system where, like the ones I was describing earlier, where like, it pays the creators, and maybe those creators have some control over that system, and maybe they can decide on upgrades, and they can vote, and like, how does that voting work? And like, how is it a democracy, or is it, aristocracy, oligarchy, or what, how, you can design it. Like, I don't know, like, let's have that, I just think it'd be like, to me, it's like, wow, that's interesting, let's have that discussion. And so I'm just trying to kind of provoke that discussion as opposed to saying we've fully figured it out.
I wish we had it figured out, because as this democracy crumbles, we need a place to go. I only mean that half in jest. We have plenty of worries about where things go with this democracy. And
I guess broadly, what I'm trying to do in the book generally is open up what I think to a lot of people are opaque systems. You just go on this phone and you use these things, and I'm trying to open it up and explain how they're built and how they work, how the economics works, how the control works. I'm having worked on it for 25 years, explaining all of that, how it works, explaining my proposed solution for how to improve it. But I think even if you don't agree with my solution, I've heard from a lot of people, and I would hope people here would feel that way, that just the first part of kind of breaking it down, explaining how it works, might be eye-opening to you, because I don't think people have really kind of dug into that. Just sort of people take it for granted that like, oh, this is how the internet works. 5 people control it, like,
I do think it's important to understand how this stuff works, because if you had the wherewithal to come online and watch this, to read Chris's book, to be here in the room, you're positioning yourself to be one of the decision makers, to be a person who educates others as to how these systems work, so that when it comes to it, and it's coming to it, decisions are made about protocol governance or blockchain governance, blockchain protocol governance. That for me, I think, is one of the great lacks, is that people don't know what they do. So in that theoretical triumvirate, nobody really knew what the difference is, if there are larger blocks or smaller blocks, and so there wasn't. People had lacked capacity to participate well. So you had instead of that, you had what stands in for debate online, which is not really very good stuff. Any questions? I'm happy to have received some online, but I'm happy to take questions from the audience. Mr. Roger Cacchetti, I'd like to see you, sir. How are you? Please, and then I'll go to the others next, over on this side while the microphone's there.
Yes, my name is Roger Cacchetti. I'm an editorial contributor on technology policy for the Hill newspaper, and have been around this industry for quite a while. And I'd like to raise with you an alternative future that could well emerge, as radical as the introduction of the iPhone, or for that matter, the emergence of the internet itself. To understand it, we need to go back a little bit more than 30 years. In the early 1990s, my assignment was to evaluate the future of the internet and should we interconnect with it. I went to the experts at Bell Labs, said it's going nowhere. It's a dead end. I went to the experts at IBM Research. It's going nowhere, it's a dead end. The future is online private networks. Private networks that are online. And the future was going to be as fantastic as the internet today is, but is entirely contained within an online private network. And for those of you who are not old enough, at that time there was AOL, Prodigy, and CompuServe, and each was closed to its users. In those days, owning the transport layer on a global basis was politically, legally, and financially inconceivable. The transport layer was the PTTs of all these countries. Today, the cost of deploying a communication satellite has dropped from about $200 million to about $20,000. It is conceivable for one to put up a global network of communication satellites and own the transport layer. And when you own the transport layer, you block out everything but your service. You could give away the receiving equipment and pay the users to join so that you get 1 billion users quickly. Gee, I can't think of anybody, any of those 5 big platforms whose owner also owns a global satellite network. But think about it, and you'll see that the cost of owning a global transport layer today, $100 million, maybe a couple $100 million at most, which is peanuts in this. So why wouldn't the alternative future be back to the future of the early 90s, where you own your global transport layer, your satellite network, you own it, and the internet sort of peters away because you know, there's cost, but if I'm an advertiser, the rates are lower, I can get 1 billion people. If I'm a user, they pay me to subscribe to this network, blah, blah, blah. So why wouldn't that be an alternative way to deal with this? And why wouldn't investors like you be looking at a future of private online networks where you own the transport layer yourself as well as all of the content? Thank you.
Well, there's a lot of questions embedded in that. So first, it's interesting you brought up that people thought it was going to be a private network, because I think that's a good point, and it's often overlooked. That there was a real question in the 90s as to whether clearly we were going to connect all the computers in the world. The question is, were they going to get connected in an open, decentralized way or by a company? And a lot of people thought it was a company. And in fact, you know, my partner in the firm is Mark Andreessen, who built Mosaic, and we talk about this. He would have a different take on it. His take was that, like, you know, why did his side win? Why did the kind of open side win, the website? And he thinks it's because they got the developers. That they made a system that was so easy to use that anyone could build a website, and they got sort of the masses said, hey, I want to do that. I want to build a website. And it was, I don't know how detailed you want to go on that, but like a lot of the decisions they made, technical decisions and design decisions, were built around like making it super easy for people to come on and join and making it inclusive. And even though at the trade-off of even being slower and clunkier, because like Comcast, and you know, if you know, like they had this whole like internet city in Florida, and they had like, you could watch a movie on demand in 1992, but it was closed and no one could build on it, and Mosaic was open. And so anyway, that's a separate thing. I think on the transport layer, great question. You know, that's a whole, we could spend an hour on that, but the net neutrality, you know, this is this big debate, net neutrality. That's about that's about keeping the transport layer open. I always thought that was a sideshow, because like while the transport layer has actually been pretty good, like meaning like mostly the ISPs, the Comcast, the whole kind of transport layer has stayed, you know, pretty reasonable. Like they charge you a fee, they make a lot of money, but they haven't been like, you know, they haven't exerted the power that they could, in my view, and I think that's for a lot of reasons, including regulatory. The satellite thing, look, I mean, maybe you'd have to build a satellite system that would be so compelling that people would switch off of the existing systems today. Because the systems today, you know, you have bandwidth is not really the rate limiter, you know, and so, and you have all these undersea cables, and you have all this sort of, you know, I can access anywhere in the world at 200 milliseconds. So I'd have to learn more about it, but it seems like that wouldn't be my obvious way. Like I would guess that satellites like Starlink today are more complementary to the existing transport layer than a replacement, than a substitute, but it's very interesting, and it could happen, you know.
I think we had another question at the same table. Sorry, I can't greet you by name, but you're very welcome. Thanks for your question. Go ahead.
Well, you should know me, Jim. I worked with you.
Oh yeah, you're wearing a beard nowadays.
Thanks, Chris. My name's Paul Jossi. So I have a question about decentralization and re-centralization, specifically as it relates to proof of work and proof of stake. So, you know, Ethereum, which you've mentioned several times, switched from proof of work to proof of stake, and I can see it. And I want to preface this also with the ESG debate. So, you know, Bitcoin gets attacked all the time for its energy output, and that was a premise for Ethereum, and all of these other ones. They're almost all proof of stake now. And so, how concerned are you? I mean, you mentioned like you can create your own governance, but if you have Ethereum or any of these other proof of stake ones that come in, you can have somebody that's really rich and really politically oriented, like Bill Gates or somebody come in and essentially buy a governance with a proof of stake that you can't with proof of work, because
But proof of stake is not on-chain voting. It's like you can't. Ethereum is not governed by token votes. It's governed by the software. It's just like Bitcoin in that to take over Ethereum, you'd have to take over all the software providers, which include not just the validators, which you're referring to, but also all of the wallets, all the node providers, Coinbase. You'd have to get all of these people to collude, all the different software clients, which is not simply a financial kind of calculation. It would be a very difficult thing to do. And I would argue just as difficult as with Bitcoin. So I don't know that. I don't know if you're like a Bitcoin. It sounds like you're a pro Bitcoin. A lot of the pro Bitcoiners don't like proof of stake, but I would argue it's a similar kind of difficulty of system takeover as proof of work.
So you don't see any centralization problems with proof of stake?
Well, there's people. If you're familiar with like Lido, people will say like Lido. Sorry if I'm going. I don't know how deep you want to go, but like so there are these pools. Essentially, like it's like equivalent of Bitcoin mining pools, right? So there's staking pools, but I haven't. I mean, like for me, that doesn't really change the game theory. You still need to get all the individual token holders who are validating the wallet. Every user that has a node, you still need this sort of massive collusion to undermine the system, and no one's come even close to it with either Bitcoin or Ethereum. So, I mean, it's always a possibility. I just don't think it's an actual like near-term threat. I worry about a lot of other things before that.
Is one of those things ESG? That's my last.
ESG, like the energy use of proof of work?
No, like, well, yeah, sort of the environmental attacks, the energy attacks on crypto in general.
Well, yeah, I mean, so for those who don't know, like Bitcoin uses a method called proof of work, which is very energy intensive. Ethereum used to use that and switched to proof of stake, which is far, far less energy intensive. I have a chart in the book showing the comparison of the energy use. You can debate. You can also. Some people believe proof of stake has other better properties. You can debate. I don't want to. It's like a religious debate. So but it clearly has better electric. Like if I were a Bitcoin maxi, like the Bitcoin people, I would be worried about. The Biden administration tried to do price higher prices on Bitcoin mining. I think you're going to see a lot more regulatory kind of crackdowns on Bitcoin mining. So I do think that is going to be a growing issue for Bitcoin.
My dream would be that debates like this, of which we're all having only a mere taste, would be analytical debates as opposed to religious.
Yeah.
And I think there's a long way to go till we get there. Did you have a question? My good friend, state your name please, has a question.
Thank you. Trevor Jacka. I'm a builder in this space.
Oh, great.
And that's really where my question is. So as a builder, it's a global industry, and you talked about this Darwinian struggle of entrepreneurs. Just curious how you see that Darwinian struggle, spreading out across the globe, and where the United States fits in that from that entrepreneurial standpoint over the next couple of years.
Yeah, I mean most of the stats show the kind of U.S. share declining from developers, like the developer stats, for example, declining if you look at GitHub stats, and I think that's the policy approach here, which has been, I mean, at this point too, like a lot of projects we're involved with block the U.S. has been becoming a more common kind of approach to launching. I would say pretty clearly the U.S. is the most negative regulatory environment for the space, even more than Europe, which is the first.
The U.S. is the most negative?
Yeah, definitely,
of all?
definitely. And even more than Europe, which I've never seen in tech. Like, this is the first time I've ever, in my career, we've always just assumed the EU is like the most sort of anti-tech, and then the U.S. is sort of in the middle, and Asia is sort of pro-tech, is kind of the regulatory landscape we've dealt with in the past, and now I don't think that's the case in blockchains. We'll see in AI, like AI, the EU Act thing, I haven't read it carefully, but it looks pretty, I think it's probably too strict on AI, and we'll see what the US does on it. But yeah, I don't think we've done, I think it's just been a really bad policy approach, and has hurt developers here, and more people are moving abroad or blocking the US. They just can't access the product at the US.
This is another, we talked about how the regulatory environment keeps the highest quality entrepreneurs from coming in. That's, I think, less recognized than it is the fact that heavy regulation in the U.S. weakens the role of the U.S. in this sector, and even when it comes to financial surveillance, weakens the ability of law enforcement
Why
to
do we have
access.
so much power over the last generation of the internet because they're all here.
Yeah,
You know.
yeah, yeah. So, I think this latter point is starting to get through. That I mean, my colleague Paul Ryan, who was also a former Speaker of the House of Representatives, has been on this stage talking about that very problem, that that U.S. regulation that pushes things overseas is detrimental to the interests that U.S. regulation is supposed to serve.
Yeah.
So there actually has to be a more deft approach.
I mean, we as a firm had never had a non-U.S. office, and now we finally have a U.K. office, and that's because of the blockchain regulation. And we had a principled stance to not have a non-U.S. office, and we broke that last year because of this. So, like, that's our view. I know, it's unfortunate.
We'll do right there, and then go to the next table over after that. Please.
Hey, so I wanted to know, what's the most exciting use case of Web3 besides being able to share profits with people who are not accredited investors, which is amazing, but besides that, is there anything that you can't do like on a centralized system like AWS?
Thank you for asking. The last section of the book is 7 applications. So I wanted to take, so people sometimes say, hey, you're being theoretical and abstract, and so I wanted to be very specific and go through 7 applications, and it's like social networking, financial services. Let me give you one that I just think is a cool thing that I think is fun that we have 2 investments that are doing. It's called collaborative storytelling, and so the idea is you have these internet communities who are super excited about Star Wars, Harry Potter. I don't know if you've spent time on like Reddit where they talk. There's people are very passionate about this stuff. Okay, so. Now imagine if you could create something where those users could come together and create new narrative universes, the next Harry Potter, the next Marvel movie, collaboratively, like thousands or hundreds of thousands of people coming together and collaboratively creating those things, getting rewarded in tokens for that contribution, proportionate to how much. So if you contribute a lot, the other people say you contribute a lot, you get 5%, someone else gets 2%. And then if that collaborative universe generates movies and games and comic books and whatever it might be and generates revenue, those profits flow back to that user base. And what's cool about that is it's sort of like Wikipedia for encyclopedia. You have the crowd come together and create an encyclopedia instead of it created by a centralized organization. But it also is, I think, exciting. 2 other reasons it's exciting. One is, if you think about Hollywood, why are there always just sequels? If you ask people in Hollywood, in the superhero movies and sequels, and why don't you do new stuff? If you ask them, it's because it costs $500 million to market a new narrative universe. So what if instead you have this pre-baked, passionate user base that already loves it? Like, to me, that's a really cool idea. They can go out and evangelize it themselves. The second reason I like this idea is we have this freight train coming called generative AI, where you're about to be able to type in a word and create a song and a movie. And this creates a new role for creative people in that world. They can come together, create the universe, kind of gather the attention, evangelize it, use those tools, but the tools are not replacing them, they're complementing them. So that's just like a cool new thing. So there are the way I think about it is new kind of tech, like blockchains allow you to do old things better, like social networks with better economics, but also just brand new things you couldn't do before like this.
Let's come over here to this table right here. Another one of my good friends. I'm so chastened by missing Paul that I'm going to claim friendship of everyone. Nice to see you again. Thanks for coming.
It's a pleasure to meet you. And thank you for such a fabulously interesting discussion.
Thank you.
I'm going to pick up on the other question that this gentleman asked in your response. I'm a former Treasury attaché to Europe, actually, so I will tell you part of the reason why the regulatory environment in Europe is so much more friendly when it comes to finance and fintech and currencies is it's about the reserve currency, it's about alternative payment systems, it's about 20 years of weaponizing the dollar. However, that's not my question. My question involves the blockchain. You talked about the hurdle rates you're evangelizing for more use of the blockchain in a lot of different places and a lot of different use cases. And I'm wondering, do you know what percentage of economic activity today occurs on the blockchain that is not related to cryptocurrency? That's question 1. I'm assuming it's very small, so the bigger question is question 2. Do you really think the hurdle rate is the people not having the capacity to understand that they can tokenize just about every bit of information involving themselves and their wallets? Or do you think it's access to developers? Which is why I loved your question, because there's a ground war underway in among the big tech companies, they're buying entire teams. The capacity for any small entrepreneur to actually develop an AI application to tokenize language, to tokenize data, to be put on the blockchain. I'm not sure I see that there's the way for small companies to compete. I'd love to know what you think.
So I understand that. So maybe, sorry, could you clarify? So you're saying that small companies can't compete because of the...
Because they're hoovering, the larger companies are hoovering up the talent. I mean, and the Wall Street Journal's been writing about this. I mean, they're buying entire teams. A lot of what used to be called seed funding in the $3 to $5 million range is now being used just to hire a bunch of people. And that sucks a lot of energy out of entrepreneurship.
I don't think that's accurate, to be honest. I mean, like we have... I know, but they write a lot of stuff. I don't know, like tech stuff that... I mean, we have 700 companies. We're one of the biggest Silicon Valley VC firms. M&A is almost stopped. I mean, as far as I can tell. I mean, there's occasional things, but like after Figma, like no one wants to even enter an M&A thing because like what happens is
Figma is...
Oh, sorry, Figma was blocked by the DOJ. It's a design application that Adobe entered an agreement with. But we had another one. What was it? This is all public. Supernatural. It was a small VR company that was supposedly I mean, VR is not even a market, let alone a monopolistic market. And yet it was, so what happens is you get stuck in this limbo for a year and it's just really like, no, like it's like, you know, Figma will be fine, but like most companies it kills you to be stuck in that limbo for a year. And so unless you have like a massive breakup fee, you know, I don't know, like I'm telling entrepreneurs don't even consider like selling the company. And there's little acquihires here and there, but usually it's like acquihires are a term for like kind of a small acquisition, but I don't know. I mean, and I'm an investor in a bunch of seed funds. That's not my impression of what's going on. And in fact, I think if anything right now, like we funded a whole bunch of people leaving places like Google and they repeatedly say they can't build products. It's so bureaucratic. Like my impression is, like Facebook's probably a little better. It's the only founder-led big tech company, and they just like laid off a whole bunch of people, and they're trying to stay lean and efficient. But a lot of these other companies are just very bureaucratic. People are very frustrated. If you look at like venture funding, like our firms, they're just basically all the big teams are leaving, AI teams, the big companies, and then raising money from firms like us. There's been a whole series of these recently. So I see it more as I kind of see it as like we're in eras of like splitting and combining, and I think of it more as a splitting era. Like if you're a team at Google, like you're kind of like, why am I stuck in like 8,000, PowerPoint meetings, having to prove to bureaucracies that I can build this product when I can just leave and honestly raise money at like very attractive terms. So I don't know. I'd like to see the journal's data source for that, but that's not my impression at all. But
that's encouraging.
Yeah. No, I think it's sorry.
Let's take one more in the back right there, and then I've got a barn burner that we'll bring it home with.
All right.
We'll see. I may have just overpromised.
Hello, Jacob Snyder, fellow for the American Moment. So one of the biggest things I miss about the old internet and what I see as like the most fundamental to like this ability to read and write information was the fact that you could really be anonymous on like a lot of the platforms before they like became all consolidated. And I really see we lost this anonymousness with like the consolidation. It's like, let's say, those big 5 companies, Facebook, Google, Meta, for me to go ahead and be able to like really freely read and write information without, feeling like I'm being tracked. So cryptocurrency technology, which, ownership seems, your third moment, but it seems like cryptocurrency technology like initially promises like us this ability to, we can still like move on to this new like anonymous age of like ownership. But as I see like, high finance, venture capital, big banks becoming like more involved and starting to offer services affiliated with like cryptocurrency, are we going to inevitably see like the loss of anonymousness in our ability to go ahead and own these things? And how it was like even 10 years ago of cryptocurrency, right?
Yeah, I think the reality, like Coinbase has done KYC, Bank Secrecy Act stuff since its inception 12 years ago. So you're not anonymous in any of these. That's just the law, and they've complied with the law. And Yeah. So I mean, I think look, the reality is no, you're not going to have anonymous money, and that's the law. That's because it's the law. And so, yeah, I think that is just mostly not. I think anonymous speech, different thing. And like, that poses far fewer kind of policy maybe challenges. I don't know. A lot of these platforms still support, like Reddit and things. A lot of people are pseudonymous or something, right? You have to build up your karma. So that some of them, still support it. Yeah. So, but I don't think you're going to have any kind of anonymous money in any developed country, period, just for legal reasons.
I have all kinds of papers and constitutional
Yeah.
law to share with you
Yeah.
at another time.
I'll defer to you on whether that should be the case. I'm
It's
just, as a practitioner, I'm just saying what we tell people. So.
My belief, it's of the essence to
Yeah.
have to be able to have anonymous.
Yeah. I mean, you can have that. I'm just saying,
or
like,
you're lost.
as
But
somebody who advises
Yeah.
entrepreneurs on what the current state of things is, like that's what we advise.
any one company is
Yeah,
not going to be able to
yeah,
take on that
yeah.
fight. Let me ask you this one. I get it. I enjoyed the book. It brought me back. So I grew up in Northern California, where the People's Computer Center was where the hippies got a hold of a mainframe, and we would go play our games, and early programming and basic on the little computers and things like that. The vision that is reflected in the early parts of this book, I get. What I don't know, what I don't understand is, how are you planning to make a lot of money in lowering take rates?
Yeah.
You're an investor and you're leading an investment firm in this area. Why does this make sense?
Yeah, so I think it's like the way I would analogize it, like imagine you were early in Bitcoin, right? And you said I'm going to buy a bunch of Bitcoins, and I make money on it by owning those Bitcoins. But I also think this, if this is successful, it will create this, kind of economic layer of the internet that will be far bigger than us. So it's like the economic logic is own a much smaller piece of a much bigger pie, right? And so if one of these social networks is like the new global substrate for social networking, and we own, it's literally when I first raised our first kind of blockchain fund, I said, like, if we're right, there'll be a few like protocols that are worth trillions of dollars, and if we can own like 1% of a couple of those, it'll be very successful, right? And so sort of very, very much sort of shooting for those outlier things, and that was years ago. Before, I think Bitcoin is worth more than $1 trillion now, and Ethereum's, I don't know what it is, a couple $100 billion. So like it's not, if you believe those are sustainable valuations, like that's not inconceivable, and then maybe that's the beginning of a 30-year trend of like more and more of these valuable protocols. So that's kind of the economic logic.
Okay.
Much smaller piece of a smaller piece of a bigger pie.
It's a bold vision. How many book events have you done so far?
Yeah.
How many more do you have to do
So the book came
to
out
make
2
this a
months
reality?
ago, and I've been kind of on a book tour. I've been to this is my Boston. I'm going to Boston this weekend. That's the end of it. So I went to SF, London, LA, New York, here this week, and so after that, and then it's going to be mostly digital and a few events. But anyways, thank you all for your time.
The reality is
I've
just
really
around the
enjoyed it.
corner. Thank
Yeah.
you all for coming. Thanks, Chris Dixon,
Thank
for
you.
presenting your book, Read Right On. We'll see you there again. Thanks, everyone.
Thank you. That was fun. Thanks.